You know how the stock market recently had that ridiculous attack of Tourette's syndrome? Sell, sell, sell! Buy, buy, buy! Plunging 700 points in 15 minutes, then bouncing back up in the next 15? What really unnerves me is not the event itself, but the expert's reaction to the event. My God, how could this have happened? We've got to find the cause. The reason I find that unnerving is that the experts in charge seem to not understand even the most basic nature of what they're supposedly expert in. It's as disconcerting to me as hearing the captain of a ship that's just struck an iceberg being astonished that the ship is sinking. I had no idea that a little hole in the side could make such a difference. I thought ships floated because they were pointy in the front and blunty in the back. Who the hell am I to make such a damning criticism? Listen. I'm no expert, but I do know that the stock market is what's called a nonlinear system. That's the whole chaos theory thing, where the flap of a butterfly's wing in Asia can cascade up until you get a hurricane in Texas. That's because nonlinear systems have feedback loops, like a microphone in front of a speaker, or a bunch of sell orders driving the price down, sparking even more sell orders, and so on. Nonlinear systems are notorious for their ability to be tootling along fairly predictably, and then suddenly fly off violently in a totally unexpected direction. So looking all flabbergasted when that happens is either disingenuous or just plain ignorant. Either way, it's deeply disturbing to see. When I see all the inquiring and the blustering and the we'll get to the bottom of this thing that's been going on, it strikes me like ancient villagers needing to invent a thunder god to explain the thunder. Oh, the gods must be angry. There's got to be a reason for this horrible event. Such things don't just happen. Well, actually, yeah, such things do just happen. And the people in charge of the system sure as hell should know that. Listen, the stock market has always been a nonlinear system. But in our quest for ever greater efficiency, fully 3/4 of the trades on the stock market today are made up of algorithm trades, where trading decisions are made and executed by computers in milliseconds. Yeah, you heard that right. The computers are the ones that actually make the buy and sell decisions. It's called algorithmic trading. Look it up. So the feedback loops are now so tight that there's no time for real people to reassess the situation as it unfolds. When a new situation comes up that the programmers didn't anticipate, the algorithms can just run off on their own and end up cranking the wheel to port when the human traders would really rather be turning to starboard. That's why all the "we're going to get to the bottom of this" is what I find the most distressing part of the whole event. If they don't find a cause, a fat finger trade to point the finger at, you can be sure the plunge will be described as a perfect storm or a 100-year flood or any other disastrous but really unlikely event, with the intent that you will feel calmer and will continue to be confident that we can keep chugging along with business as usual and not expect to have anything like this happen again in the imaginable future. Go on home, folks, there's nothing to see here. And if they do find a fat finger trade, or even a single large but valid trade that they can point to and say this was the cause of the plunge, does it make you comfortable to know that the whole stock market system, which the entire world takes its cues from, is so fragile that it can be so affected by a single hiccup? Does it make you feel confident that the ship is well designed and in good hands? And far from being the cause of the plunge, any such hiccup would only have been the trigger. The cause of the plunge was not a single trade. The cause was the nature of the system, nonlinear, highly efficient, and optimized. So the solution is not to just tweak the system. We tried that after the 1987 crash by installing circuit breakers at the New York Stock Exchange, and it didn't prevent this flash crash. That's because the system evolved and continues to do so. The solution is to make the system more resilient and perhaps to not have so much of our national psyche invested in it so that the stakes are a little bit lower if there is a big surprise. Build in some safety margins, some cushion, so that when the unanticipated happens, we don't get totally hosed. Such contingency planning used to be part of our national ethic. Remember, save for a rainy day? But now instead of prudence, our national ethic has become efficiency and cutting all waste. That is, anything more than what's absolutely necessary. One person's safety margin is another person's waste. Just ask BP how it worked out to cut such unnecessary waste because a large spill was unlikely from their Deepwater Horizon oil rig. We didn't plunge into the abyss this time. But maybe this was the tree branch shaking. Maybe it's finally time we start to talk about the taboo questions. Like, does more efficient necessarily mean more desirable? Is it worth continuing to unquestioningly accept what the economists and the financial wizards say is good for us? Should we be investing so much of our national identity in how the stock market is doing? Should we even be using the economy as the primary measure of how we're doing as a society? Could there perhaps be other, broader ways to measure our collective well-being? Perhaps ones that acknowledge something other than the growth of monetary wealth? And here's a couple that will definitely get me relegated to the socialist bin. but they deserve to be discussed. Is the idealized free market really the greatest good? Is steady growth of the GDP really a wise thing to hang our collective hat on? We've adopted it as our #1 national goal, but steady growth is exponential growth. And when stuck on a planet with fixed resources, any mathematician can tell you that it's guaranteed to crash spectacularly. To me, the clear lesson of the recent plunge in the stock market, the financial disaster of 2008, and even the recent BP oil spill is, we simply got to be more cautious. Our national ethic of go for it, we'll cross that bridge when we come to it. If it hasn't been proven to be dangerous, then it must be safe, so full speed ahead, is going to get us hosed. Whether that comes in the form of financial collapse, a greater depression, peak oil, or some other resource issue, the stakes are the whole world. So let's be a little more careful and a little less arrogant about how well we understand the situation before we bet the house on it. This is Greg Craven, just trying to think things through.